Okay, we're now going to work through the long and involved example that is in your text in Chapter 6. So let's take a peek again at our illustration of the flow of putting together the budget. Again, everything is going to start with the sales or revenues budget, and we're going to work our way through the system. Next, we will perform a production budget. Included in this calculation, we will come up with the number of units in ending inventory. So there's an ending inventory budget that is related here. Our ending inventory, of course, in our finished goods will also end up on our budgeted balance sheet. So keep that in mind. We will then put together our direct materials budget. And of course, this is covering the number and amount for the budget items that we need in order to produce however many units are necessary on the production budget in order to fulfill however many units we need for sales, as well as to make sure we do not run out of finished units because we don't want to have any stock outs. All right, so again, direct materials, those are the direct material component items that are required for producing the item. So if you will, for Volkswagen, we need 4 tires per car. We need 1 steering wheel. We need 5 seat belts, etc., etc. Each one of those would need to be considered, and they would be calculated out. The direct materials budget, of course, is going to also have some numbers that are going to tie out. We're going to need our costs for those direct materials because those affect our cost of goods sold number. We will also have raw materials in ending inventory. Okay, we don't want to run out of stacks and stacks of steering wheels and stacks of tires because we don't want to have to go push the big red button and stop the assembly line. Okay, so we will have some ending raw materials inventory, and that value will, of course, show up on that final budgeted balance sheet. And again, the costs related to direct materials is going to show up as part of our cost of goods sold per unit in our budgeted income statement. The direct manufacturing labor cost budget, we are going to know the amount of time expected to produce our units. We are going to estimate those costs related to the direct labor per hour, and we're going to use those to put our direct manufacturing labor cost budget together. Of course, those direct labor charges are going to be included in the cost of the product. So cost of goods sold is also going to include our direct labor. And then we've got the manufacturing overhead cost budget. Again, if you need to go back and review activity-based costing, it is covered earlier in the text. You may also still have your cost accounting book from your ACC4060 class. Go and check that out if you need to do that. But also make sure that you watch the video that I loaded for you. It's about a manufacturer of treadmills and elliptical cycles or something to that effect. The name of the company is Precor, and they've got a really good example in there to refresh your memory of how activity-based costing can be utilized to give us a really better picture of the different cost of manufacturing components when we have more than one product that we manufacture, and there are a lot of differences into the amount of efforts indirect materials, indirect labor, and fixed cost, etc., that go into those different products. Okay, so activity-based costing gives us a better picture. So in our manufacturing overhead cost budget in Chapter 6, you guys are going to be utilizing activity-based budgeting in order to help us develop those numbers for that manufacturing overhead cost budget. And again, our manufacturing overhead is also part of our manufacturing cost related to the product, and therefore our cost of goods sold per unit is also going to include those. So notice that direct materials plus direct labor plus manufacturing overhead are going to help us to develop our cost of goods sold number and our cost of goods sold budget. We'll also put together a research and development and design cost budget, our marketing cost budget, our distribution cost budget. All of these items are definitely going to show up as expenses and cost on our income statement. Okay, so we've got to get those done, and then we can finally put together our budgeted income statement. Again, all of these are operating budgets and schedules, and notice that the operating budget, the last item here, is the budgeted income statement. And then our financial budgets, our capital expenditures budget, which we do have a brief example of a capital expenditure that's going to be made for our particular illustration in Chapter 6. But again, there's a chapter in the end of the text that you guys can refer to. Some of you may end up, working on the capital expenditures budget at a later date at your employer, and you might want to refer back to that chapter. So again, this is a great textbook for you guys to keep. I will show you in my upload document in regards to the CMA exam that the reason why I utilize this textbook for this particular class is it is one of the referenced textbooks for the content coverage of the CMA exam, and I will show you guys that in that document. Next is the cash budget. I do want you guys to make sure that you can calculate some of the numbers that need to be developed in order to fill out the cash budget. I will give you some example problems, and I believe on your homework you will also have to calculate some cash budget items. So cash budget, we need to know for the period that we're doing our master budget, what are the receipts of cash, and then also what are the needs or uses of cash. We're going to plan this stuff out in advance. It helps us with our cash management. Okay, we don't need to wait till the last minute to run out of money before we call our banker or issue some bonds or possibly sell some more stock or whatever it is we need to do in order to obtain financing. So we're going to calculate in advance when we expect from that revenue stream on the sales budget when those customers will be paying us. And we will also calculate if we plan to sell off any property, plant, and equipment, because we would get cash proceeds from those items, and other types of things that we may have some cash inflows from. On our outflows or our disbursements, we're going to calculate well in advance for all of those direct materials that we purchase up in our direct materials budget. When will we be paying those vendors and suppliers? We will calculate out when we will be paying our labor force from our direct labor budget. We're going to plug in those outflows. We will also plug in all of our other manufacturing related costs and expenses from that manufacturing overhead budget. Now keep in mind that on that manufacturing overhead budget, there are going to be some line items related to, for example, depreciation, amortization. Depending on the type of industry we're in, you may even see some depletion expenses, like for those oil and gas industries, those types of companies. And those line items are non-cash. Okay, so don't just go and pull the bottom line from the manufacturing overhead budget and plug it in on your cash budget, because that will not work. Those depreciation, amortization, and depletion expenses, again, are non-cash. We don't write a check for those. Those are just basically journal entries, the method to the madness of how we depreciate over time assets that were bought, etc. All right, so on the cash budget, we're only going to show literally costs and expenses that will be paid. Even on our cash budget, we're even going to show, if we're going to be making those estimated quarterly deposits with Uncle Sam, the Internal Revenue Service, for those income taxes and things like that, we will also show those on our cash budget. We will also show any capital expenditures for property, plant, and equipment, and capital improvements. All of those outflows or disbursements are going to show up as line items on the cash budget. We will even show if we have to obtain any financing. We will show if we pay back any financing. And we'll even show paying back interest expenses on any financing that has to be planned into the cash budget. Of course, the cash budget is going to have an ending balance on it for the last date of the period, what is expected to be in the account. And of course, that number would show up in our budgeted balance sheet, line item number 1. What is our expected balance as of the end of the period for our cash account? And of course, we're going to have all of our other ending balances, assets, liabilities, and equity accounts all showing up on the balance sheet as to what they would be if this budget comes to fruition. And then, of course, we could also develop a budgeted statement of cash flows. All right, so there's our flow. Let's go ahead and get into our steps. All right, so the first step is to prepare the revenues budget, aka the sales budget. So this budget looks simple, but the company should put a great amount of time in consideration of the projected sales numbers, as the remainder of the budget process relies on these projections. Again, everything is going to flow from the revenues or sales budget. When we go about putting these numbers together, factors that are going to be considered is the fact that our sales and our marketing people are going to be doing their research. They're going to be touching base with those customers. They're going to be looking to see what competition is doing. They are going to consider the general economic conditions. They're going to consider industry trends. They're going to consider market research studies. They're going to even look into the anticipated advertising and promotion that's going to be done. They're going to consider the previous market share, price changes, and even technological developments. All of these things need to be considered when we're putting together this first very important budget, the sales and revenues budget. All right, so we have a formula. We're going to take the sales price per unit and multiply it times the number of units to be sold, and that, of course, is our total sales revenues in dollars. All right, so there's the first formula. The second step ties right in using some of the information obtained from the sales budget, and it is called the production budget. We are going to base this on the numbers included in the revenues budget. And included in this budget are also projections about ending inventory levels. All right, this particular budget is expressed in units, not dollars. Okay, so we're talking about the number of units that need to be produced or manufactured. So what is our formula? Budgeted sales units. This number is the number of units from our sales budget. How many units are budgeted to be sold? We're going to take that number and we are going to add it to our target or desired ending finished goods units. What is this number? This number right here represents the number of units that we want to have in ending inventory on the last day of the period. All right, so how many units do we want to have out in the parking lot ready to be picked up if we're Volkswagen? Okay, so desired ending finished goods units. Management is going to determine an amount. Again, keep in mind that we're talking about inventory management. It's kind of like Goldilocks. We don't want it too hot. We don't want it too cold. We want it right in the middle. All right, if we have high inventory, we've got a lot of storage related cost. If we're Volkswagen, if we have high inventory, we got to have a huge parking lot to store those things. All right, security guards, etc. What if we're a place that has to have climate controlled? Okay, air conditioning is expensive. Security guards, lighting, what other kinds of things may have to be controlled in order to store inventory? If we have too much of it, we're wasting money on those storage costs and other things, let alone what we have invested in the inventory. All those holding costs add up as well. If we have low inventory, on the other hand, again, that cold factor, if we run out of finished goods units, our customers are likely to go elsewhere to get a comparable product or service. All right, so if they're going to go and do that, they may never come back to us. All right, if they get a better price, better service, and possibly even a better product, we may never see them again. So we do not want to have any stockouts. Okay, so management's going to come up with this target ending or desired ending finished goods units, and we're going to make sure that we produce enough to not only sell and provide what needs to flow through to our income statement for those revenues, but we're also going to make sure that we have desired ending finished goods units on hand. Again, this number is going to be reflected in that balance sheet, okay, because you are going to have inventory showing up there, and of course you're going to have finished goods inventory as a line item. So you're going to end up taking this desired ending finished goods units, this quantity, and multiplying it times that cost of goods per unit and putting it on the budgeted balance sheet for your finished goods inventory. Now, notice that our next part is to subtract beginning finished goods units. Why are we doing that? Because we would have started the period with some finished goods left over from the last period. Okay, so the way I explain this to my principals folks is on the last day of the prior period, you had some cars on the lot. Those were your finished goods units. You went home, went to bed, came back in the next morning, and you had them still sitting there. All right, so we need to subtract the beginning finished goods units, which were the ending finished goods units from the prior period. Okay, so where would we get this number? This is related to the prior period's balance sheet finished goods inventory. how many units are represented in that dollar value. All right, so again, here's our formula. We're going to take our budgeted sales units plus desired ending units minus beginning units. And we're going to calculate the number of units that must be produced. Now this particular thing, you'll notice I've got it highlighted in red. We are going to use this number to take us through our other items related to the actual manufacturing. Okay, we're not going to go back to the sales number of units. We're going to use the required production units in order to proceed on. All right, so step 3, we're going to produce the direct materials purchases budget. This is where we calculate out the number of items that we need in order to manufacture our widgets. These are often prepared as one document. In addition to including projections about inventory levels for direct materials, management must also make predictions about direct material prices. Okay, so we're going to involve procurement department or purchasing. They are going to help us to develop some of this information. They are the ones who source this stuff out with our vendors and suppliers, and they have their thumb on the pulse of that supply and demand going on out there and these prices that we're going to have to pay for these items. All right, so we're going to consider some of their information. The formula for this would be done for every component that goes into producing our product. So imagine how involved this can be at a company that has multiple items that go into making one unit of widget. All right, so direct materials units required for production. Let's go here for a second and take a peek at our information for the illustration in our textbook. We have got a company that sells some tables. They've got 2 different models. One is called the casual, the other one is called the deluxe. They have direct materials that go into making these. They have red oak and they have granite slabs. All right, these are our direct materials. We are going to need so much of those in order to produce the casual model and to produce the deluxe model. So if we scroll here to our next page, let me find the rest of our fact pattern. I'm looking for particular information. All right, our direct materials, here we go. For the red oak, it is $7 per board foot. And then for our granite, it is $10 per square foot. So you guys are going to have to do some calculations here. For our casual table, we need 12 board feet of the red oak. And for the deluxe model, we need 12 board feet of the red oak. So apparently our tables are the same size as far as the bottoms go, the actual oak. The casual table needs 6 square feet of granite, and the deluxe model needs 8 square feet of granite. All right, so what do we need here? 12 board feet times $7 per board foot. 12 board feet times $7 per board foot. And then our granite is 6 square feet at $10 per square foot and 8 square feet at $10 per square foot. All right, so these are the cost of our items. And we can put that into our formula and go about calculating the dollar amount that is going to be showing up on our cash budget. We could also use it to calculate the direct materials or raw materials inventory that is showing up on our budgeted balance sheet. Okay, so there's a couple places you're going to be using this information. All right, so here's our formula to calculate our direct material units that need to be purchased. Direct materials units required for production. All right, so the number of units that need to be made times the number of units required for one unit is this number. We are then going to add that to the desired ending direct materials units. Again, whenever you see the word desired, think of the word target. It is the number of direct materials units that management wants to make sure we have in raw materials inventory. When the people at Volkswagen close the books on the last day of the period and they go home and go to bed, I assure you they have stacks and stacks of steering wheels, stacks and stacks of seat belts. Those are their direct materials units, and they're going to have a target number. They do not want to run out of those, just like the finished goods where they wouldn't want to run out of cars on the lot available for customers. All right, so we would calculate the number of units that need to be sitting in direct materials, add those two together. That's what we've got to make sure that we purchase enough of. But we don't need to forget that we would have started the period with some raw materials inventory sitting there. All right, so we need to subtract however many of those there were. And there's how we can calculate the required direct materials units that need to be purchased. Now, again, people, this is the quantity. These are all numbers of units that need to be required to purchase. But we're going to take these numbers and we are going to multiply these times the cost per unit. All right, so if we need 1,200 board feet of the red oak, then we would take 1,200 times the dollar per board foot in order to calculate the dollars that need to be spent for those direct materials. All right, again, direct materials is part of our cost of goods sold. So you're going to need that in your cost of goods sold calculation. So again, how do we go about doing that? Direct materials plus direct labor plus manufacturing overhead. Those are our cost of goods sold components. We would use those, add them up, and come up with a cost of goods per unit and multiply that times the total number of units to be sold and put that on our income statement. Again, with our balance sheet, raw materials inventory, we're going to have so many desired ending units, and those desired ending units times their price is going to equal our raw materials inventory value on the balance sheet. One other thing that I wanted to show you that I will also go and upload for you. Let me go find it really quickly, hopefully. I will go and upload for you. If I can get this to open. Oh, we have Word not cooperating for some reason. I'm going to upload for you some T accounts. I do want you guys to keep in mind that you can use a T account to go about calculating this number. So I will upload some blank T account sheets for you guys, and you could literally go and plug these different numbers into a T account in order to calculate these units. So I'll upload that to help you guys out. Step 4 is the direct manufacturing labor cost budget. Excuse me. Oh, no, that's right. It is prepared next. Labor standards, again, we're going to have our engineers and our production management involved in our process for figuring out how long it is going to take us to manufacture one of our items. And we are going to use some timing mechanisms in order to put that together. And we will know also from our HR people how much our cost per hour will be. And that cost per hour can have a lot of components built into that. And we are going to take that number from the production budget of units to be produced. Okay, units to be produced, not units to be sold from the sales budget, but units to be produced from the production budget. And we're going to multiply that times the direct labor that is needed in order to produce a unit. All right, so if it takes 30 minutes, please do not multiply that this times 30. That is 1/2 of an hour. Okay, so change that to 0.5. All right, if it's a 48-minute item, do your calculation. 48 minutes out of 60 equals 0.8 of an hour. All right, so you may have to do a calculation in order to come up with your direct labor time per unit. Multiply those two together and then multiply that times that hourly rate that HR helps us put together. This gives us the total direct labor cost per unit. As total. We can come up with a per unit, direct labor time per unit times direct labor cost per hour. If you guys multiply those two together, that is going to help us develop our cost of goods sold per unit. Okay, so again, direct materials plus direct labor plus the manufacturing overhead, all done on a per unit basis, can help us to develop the cost of goods sold per unit that will also help us put together that budgeted income statement. The total direct labor cost here is also going to show up on our cash budget because we've got to figure out when we're going to be paying those people. All right, so we're going to consider that number and put it on our cash budget. Depending on how we pay our people, if we owe them because we pay 2 weeks at a time and we pay a week behind or something to that effect, we would even have a salaries and wages payable number on that budgeted balance sheet. Okay, so use your accounting skills and how this stuff flows through to multiple areas. Step 5 is our manufacturing overhead cost budget. This one's a little more involved, especially if we're going to be using activity-based budgeting. It includes a budget for each item of manufacturing overhead. And even though the budget looks simple, keep in mind that each line item in this budget also has its own budget. From this particular budget, managers can determine a predetermined overhead application rate. Okay, what is the formula for the predetermined overhead application rate? We are going to take our estimated manufacturing overhead cost and we are going to divide it by the item that we are going to use in order to allocate that overhead. So, for example, our total estimated manufacturing overhead divided by direct labor hours, or estimated overhead divided by direct labor total dollars, or estimated overhead divided by total machine hours. Okay, and this is the estimated direct labor hours, estimated direct labor dollars, or estimated machine hours for the period. In advance, we're calculating that. The manufacturing overhead cost budget, its use of the activity-based costing makes it a little bit more involved, and there is the example in the textbook, and I will pull that page up here in just a second. But keep in mind, we've got cost drivers and those cost pools that need to be considered. And again, the activity-based costing, watch that pre-core video. It helps us to get a clearer picture of what goes into making these different products, because some of them are a little more involved than others. All right, so let's go and find our manufacturing overhead here. And I believe it is on one of our other pages. All right, here's our manufacturing overhead related information. All right, we've got some overhead cost. We've got manufacturing operations. They have their particular cost. And then we have machine setup. They have their cost. Now, in our numbers, I want to say that we have $9 million in cost related to our manufacturing operations. Okay, so $9 million strictly related to the manufacturing operations. And then for our machine setup, we have $3 million strictly related to machine setup. Now, again, we've got two different versions of the table. How many setup labor hours are going to be required by the casual model, and how many setup labor hours are required by the deluxe model? If these vary, activity-based costing is going to show us that we are going to be able to allocate more of these machine setup costs to the one that takes the most setup labor hours. All right, so again, cost pools, activity-based costing, go back and review it if you need to. Same type of scenario holds true with these manufacturing operations. If the casual one takes less direct labor than the deluxe model, then the casual model is going to have less of the $9 million allocated to them. All right, so we would have a formula where we would take the total $9 million and plug that in. $9 million divided by a total of 300,000 estimated labor hours required for the period. So if you divide that 9 million by that 300,000 estimated labor hours for the period, then you would get $30 per direct labor hour. Okay, so every time an hour is worked, $30 would get allocated in to the item. Right, so much goes to the deluxe model, so much goes to the casual model. Same calculation regarding the $3 million in machine setup. Again, we're doing activity-based budgeting. We're going to take the $3 million and we're going to divide it by 15,000 setup labor hours. Okay, so dividing that means $200 is going to get allocated every time a setup labor hour is utilized for the casual model and the deluxe model. Okay, so we're going to consider the labor hours and we're going to consider the setup hours. All right, so notice that these are two different things. We got setup labor hours and then we've got direct manufacturing labor hours. Don't get those two confused because they are not the same thing. So we would use those in putting together our manufacturing overhead budget. Let's see if we can go and find it already filled out because I do not have an image that I can put together for you. All right, so here we've got the number of tables to be produced. Again, this is coming to us from our production budget, not the sales budget, but the production budget. We will be making these tables in batches. We're going to do 50 tables of the casual model in a batch. And when we're talking about a batch, think of only putting 50 on the assembly line at a time. Notice that the deluxe tables has a different quantity per batch. Okay, so we can only do 40 tables in a batch of the deluxe model. So how many number of batches need to be done? Because the batches affect our number of setups. Okay, so in order to do a run or a batch on an assembly line, we're going to load up enough parts to make the number of units that can be done in a batch. Okay, so the setup time is affected. So if we can only do 50 tables in a batch and we're making 60,000 tables, how many batches will there be? So 60,000 tables divided by 50 tables per batch means we're going to do 1,200 batches. Now each time we do a batch, it's going to take so much setup time. And the setup time, of course, is going to involve how intricate, how many number of parts, etc. What kind of things do we need to do or tweak with the machinery? And notice that there's a difference. Casual tables, their setups only take 10 hours, but the deluxe model takes 12. All right, so again, this is what's helping us with our activity-based costing. We've got a lot more hours that go into a setup for manufacturing these, let alone actual direct labor hours that are going to go into them. This is just the setup. All right, so we've got differences. Activity-based budgeting is going to help us include these differences in our calculations. All right, so if we've got 1,200 batches and 10 hours per batch, we've got 12,000 hours that are going to be needed of setup hours for the casual tables. The deluxe tables, 40 tables in a batch, 10,000 tables divided by 40 per batch means we're going to only run 250 batches of the deluxe tables. But those batches are going to take 12 hours to set up. 250 batches at 12 hours a batch equals the 3,000 hours that are going to be required in order to do that. Now, notice that this equals the 15,000 hours that we spoke about just a moment ago. This is the total estimated machine hours for the period. Excuse me, not machine hours, setup hours. Going back to our numbers, we said we've got $3 million worth of overhead related cost directly related to nothing but setup. And under activity-based budgeting, we're going to take the $3 million estimated manufacturing overhead related strictly to setup, and we're going to divide that by the 15,000 hours, and that's where we got $200 per setup hour. Setup hours per table. Recall that we had a formula where I showed you direct labor per unit. Well, this is where we're having to go and take that extra step. How many setup hours per table? All right, so if we've got 12,000 hours that are going to be needed to do the 60,000 tables, then how much is that per table? So 12,000 hours divided by 60,000 tables means 0.2 of an hour per table. 0.2 of an hour at a rate of $200 per hour for setup time. We can do the same formula with our deluxe tables. We've got a total of 3,000 hours, and we've got 10,000 tables. 3,000 hours divided by 10,000 tables equals 0.3 of an hour per table for setup time, and that setup hourly rate was $200. So 0.3 times $200. We can go through the same kind of steps for our other manufacturing overhead cost. We had $9 million total, and those are based on our direct manufacturing labor hours. So let's go through here. Here are those other manufacturing overhead costs. These are related strictly to operations, not to the setup. All right, so $9 million total. All right, if we added all those together, here's the 3 plus that other 9. Our total manufacturing overhead for the period is the $12 million. But we are not going to take the $12 million and just divvy that out. We're going to do the activity-based budgeting, and that's why we're using the $3 million and the $9 million. In regards to our $9 million, we have $9 million in the operations, and we had 300,000 estimated direct manufacturing labor hours for the period, and that is $30 per direct manufacturing labor hour. Okay, so for each direct manufacturing labor hour required per table, we would multiply that times $30, and that's going to be our operations manufacturing overhead per table. Again, this is going to help us develop the cost of goods sold per unit. So again, you've got direct materials, direct labor, and the manufacturing overhead related to the units being produced. You can do that on a per unit basis to help you calculate cost of goods sold. And you can also use that cost of goods sold per unit to also help you calculate the finished goods inventory dollar amount for the balance sheet. Our ending inventories budget, again, I've just mentioned that we are going to be calculating that finished goods desired ending number of units. All right, so our ending inventories budget includes those calculations, and the number of units that we expect to have on hand. And the values, of course, will also show up on our balance sheet. The cost of goods sold budget, we've been talking about that all along. You can go through and fill out those particular line items on a cost of goods sold budget. And then we've got the non-manufacturing items, selling and administrative type of costs and expenses, research and development, all those other things have a budget. How much do we expect to spend during the period? Put all that stuff together and have that report. And these items are also going to tie in with number 9, which is our budgeted income statement, also commonly referred to as our pro forma income statement. All right, so we could go and plug in all of those numbers from our other budgets and schedules. Revenues is coming to us from our sales budget. Our cost of goods sold numbers have been developed through our other items, such as the direct materials budget, cost of goods sold, direct manufacturing labor budget, and our manufacturing overhead budget. All of those got tied in together to give us a per unit cost of goods that can be multiplied times the number of units sold for the period. Of course, we subtract that from revenues in order to get gross margin. And then we've got our operating cost and expenses that come from our other budgets, research and development, distribution, all kinds of other things. And we would put those all on our income statement. All right. We can take it even further and do the full-blown deal, plugging in our interest expenses and our income taxes. Again, this interest expense line item, we may have to come back to our income statement to plug this number in, because I mentioned earlier that when we put that cash budget together, we will be planning in advance to see if we need to obtain any financing during the period. All right, so imagine, if you will, we're doing a budget for an entire year, and in third quarter we plan to make a major investment, and at that time we are going to obtain some financing for that. Therefore, we would have some additional interest expenses incurred for the third quarter and the fourth quarter. So we would need to make sure that 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 interest expense is included on our budgeted income statement. All right, so notice here we've got interest expenses showing up. And then I mentioned we would also even include calculating what our income taxes are for the period and making sure that shows up not only on our budgeted income statement, but also on our budgeted balance sheet if we have any income taxes payable, and on our cash budget for when we plan to pay those out. All right, so think of how these things are all interrelated. Okay, I will do a separate video discussing some of these financial budget items.